Welcome to the deep dive. Today, we are taking a shortcut, really, into the mind of a financial legend, George Soros,
And we're going straight to the source, his book, The Alchemy of Finance.
which is so much more than a trading book. It's a whole theory of history and human behavior.
It has to be. And you have to start with his track record to even understand why this theory matters. The gains from his quantum funds, say from 68 to 93, they statistically demolish the efficient market hypothesis.
Demolish is the right word. What were the odds again?
The odds of him getting that record by pure chance were something like 473 million to 1.
Okay, so that's not luck. That is a system. And that's our mission for this deep dive, to unpack that system, his theory of reflexivity.
Right, it's his framework for describing this two-way street between what people think and what actually happens in the market.
And he claims that understanding the path of these big price moves is like, what, 70% of successful investing?
It's the journey, not just the destination. And the whole thing, the entire theory, it stems from what he calls the problem of imperfect understanding.
Okay, break that down for us. Because, in physics, gravity is gravity. Doesn't really care what I think about it.
Exactly. In the natural sciences, the subject matter exists completely independently of our thoughts.
But not in social systems.
Not at all. In markets, in politics, the participants' own thinking, their biases, their hopes, their fears, they are an integral part of the situation they're trying to understand.
So we're part of the equation we're trying to solve. We aren't passive observers, we're active ingredients.
Precisely.
So how does that connection, that, lack of separation, lead to all this instability in these huge historical movements?
Well, it creates this continuous two-way feedback loop. And this loop is made of two functions that are always, and I mean always, interacting with each other.
Okay, so two functions. Let's unpack them. What's the first one?
So first, you have what he calls the cognitive function. This is the passive part. It's us trying to understand reality.
Just observing.
Yeah, placing a value on future events, trying to make our perception reflect what's actually out there. It's, what we'd call analysis.
Sounds pretty straightforward, pretty rational. But the second function is where things get messy, I'm guessing.
That's where it all happens. The second is the participating function. This is the active side.
This is us acting on our beliefs.
Exactly. Our expectations and our biases start to affect the very reality we were trying to observe. So perception actively changes reality.
So my belief that a stock will go up makes me buy it, which makes the price go up, which then reinforces my belief that I was right.
You got it. It's a closed loop. And when those two functions collide, neither the views nor the situation stay the same. They just reflect and influence each other over and over.
But if that's always happening, why isn't every day a total market meltdown? Why the periods of calm?
That's the crucial distinction Soros makes. The intensity of that loop changes. Most of the time, the market is in a state of what he calls near equilibrium.
So reflexivity is weak.
It's very feeble. There are corrective mechanisms, things like arbitrage or fundamental value, that stop perceptions and reality from drifting too far apart. In those times, classical economics kind of works.
Kind of works. But those calm periods are really just setting the stage.
They are. The real action, the big money, it happens in far from equilibrium conditions. This is what Soros calls historical change.
And that's when the feedback loop gets strong.
It becomes incredibly strong, self-reinforcing, and the changes become irreversible. This is where equilibrium theory is just. It's totally useless because the system isn't moving toward balance, it's running away from it.
And this leads to maybe the most provocative idea in the whole book. His claim that social science can succeed as alchemy. What does he mean by that?
It's a really deep point. In natural science, like physics, a theory only works if it's valid, if it's true.
Right.
But Soros says, in social matters economics, politics, a theory can be effective without being valid, simply because the participants are so easily influenced by the theory itself.
So, if enough people believe in a flawed idea, the market will start behaving according to that flawed idea.
For a while, yes. It's a self-fulfilling prophecy. Take the efficient market hypothesis itself. If everyone believes markets are perfectly rational, they stop looking for mispricings. They stop questioning things.
Which ironically makes the market less efficient.
Exactly. It removes the corrective mechanism, making the market more vulnerable to these huge bias-driven booms and busts. The belief makes the flawed theory temporarily true.
That is a total mind bender. Okay, let's bring this out of philosophy and into the markets. How does this play out with actual stock prices?
Well, Soros says stock prices aren't just passive markers of a company's value. He calls them active ingredients that actually change the underlying fundamentals.
The price itself affects the business.
Yes. And the classic example of this has to be the conglomerate boom back in the late 1960s.
Ah, yes.
Here you go.
A perfect self-reinforcing process.
It's perfect. The prevailing bias back then was this obsession with growth in earnings per share. And nobody cared how you got that growth.
Right, so a company with a high stock price, a high multiple, could use its own overvalued stock as currency.
And go buy a company with a lower multiple. They're essentially buying earnings for cheap.
And the moment the deal closed,
Oh, boom. The acquirer's earnings per share number jumps up, which investors saw as justification for the high multiple, which then pushed the stock price even higher.
so the financial engineering drove the stock price, which enabled more financial engineering.
A perfect reflexive loop. But it had nothing to do with the underlying business reality. And eventually, that reality catches up.
Because they had to keep buying bigger and bigger companies just to keep the growth rate accelerating.
And the debt piled up, the management complexity got out of control. Once the stock price faltered, the whole house of cards came down. The math that worked on the way up worked just as powerfully, but in reverse, on the way down.
We saw the same kind of dynamic with the mortgage REIT debacle he wrote about. What was the reflexive part there?
It started with investors seeing these REITs as high-growth machines. So they paid a premium for the stock.
And that premium, that high stock price, was effectively cheap capital for the REITs.
Exactly. So the perception of growth allowed them to raise funds on the cheap, which they used to expand their mortgage portfolios, which then created the reality of growth.
A virtuous cycle. For a while.
For a while. But that rapid expansion led to more competition, margins got squeezed. To keep meeting those high investor expectations, they were reflexively forced into taking bigger and bigger risks.
On longer-term loans, riskier properties.
Anything to keep the growth numbers up. So the perception, the need for growth, was actively degrading the reality of their loan portfolios. And that led straight to the collapse.
So if stocks have this intermittent reflexivity, Soros says currencies are different. He says they're continuously reflexive.
That's right. He argues that freely floating exchange rates are just inherently unstable. And this is the key part. Speculation doesn't fix it. It makes it worse.
That flies in the face of standard economics, which says speculators provide liquidity and push things back to equilibrium.
He says they do the opposite. They reinforce the trend and increase the disequilibrium. Currencies, he says, move in these huge, multi-year waves.
So as a trend gets going, say the dollar is strong for a few years.
More and more people jump on board. The prevailing bias becomes simple trend following. It feels safer to just go with the herd, and that attracts a massive amount of speculative capital.
And it's the size of that pile of capital that makes the reversal so violent.
That's the critical insight. It's not the daily flow of trades, it's the accumulated stock of capital built up over years. When the fundamentals finally turn, the liquidation of that enormous position causes a catastrophic acceleration in the other direction.
The longer the trend, the bigger the crash.
The more painful the adjustment.
Okay, let's zoom out to the macro level, the credit cycle. Soros points out it has this very distinct asymmetrical pattern.
The asymmetry is the whole story. The boom is, in his words, drawn out and accelerates gradually.
Which gives everyone time to get comfortable, complacent.
Exactly. While the bust is sudden and often catastrophic.
And this goes back to the reflexive link between lending and collateral values.
It does. I mean, a boom starts sensibly enough. Credit expands. That stimulates the economy. Asset prices go up.
So the collateral backing the loans looks more valuable.
Right. It makes the lending seem sound. But over time, those collateral values, think real estate, become less about the real economy and more about the stimulative effect of new lending being constantly pumped in.
So the value of my house depends on the bank being willing to give my neighbor a loan to buy a similar house.
You've got it. And once that new lending just fails to accelerate, or God forbid it slows down, that reflexive support vanishes.
And the whole thing unwinds.
It unwinds incredibly fast. Collateral values collapse, you get forced liquidations, and that's why the bust is so violent compared to the slow, steady boom.
And there's no better example of this on a grand scale than what Soros called Reagan's Imperial Circle in the 1980s.
What a bizarre, unique situation that was. You had a strong economy, a strong dollar, a huge budget deficit, and a huge trade deficit all at the same time.
Which should not happen. I mean, a massive trade deficit should weaken your currency and drag down your economy.
It should, but the circle held. And it was pure reflexivity. The stimulus from the massive budget deficit was so powerful, it just overwhelmed the drag from the trade deficit. That kept the economy strong.
Okay, and what about the strong dollar?
That was sustained because global capital inflows were bigger than the trade deficit. The world saw the strong U.S. economy and high interest rates and just poured money in, which propped up the dollar.
So the perception of U.S. strength kept the dollar strong, which allowed the U.S. to fund the deficits that were, on paper, supposed to weaken the dollar. It's a beautiful paradox.
Beautifully unstable. Soros saw that the high dollar and high rates would eventually have to choke off the economy, creating the conditions for a catastrophic dollar collapse.
It was a system heading for a cliff.
It was, and it was only averted by deliberate policy intervention like the Plaza Accord. The authorities basically admitted the market couldn't fix itself.
That same era gave us the S&L crisis, which is a textbook case of regulatory reflexivity, right? A failure of imperfect understanding among the people in charge.
A total failure. The authorities had this bias that deregulation was the answer to everything. So in 1982, they removed a ton of constraints right when the industry's capital was already wiped out.
Terrible timing.
The worst. They thought they were creating freedom, but they were really just unleashing instability.
And of course, the S&L operators reacted reflexively to that new freedom.
Of course. They knew the government insured all the deposits, so they were incentivized to take insane risks. If they won, they kept the profits. If they lost, the taxpayer footed the bill.
And you get guys like Charles Knapp at Financial Corporation of America who just grew aggressively, assuming he'd become too big to fail.
His perception of a government backstop allowed him to drive his institution's reality toward maximum risk. The regulators were always one step behind, trying to fix the last crisis.
Let's take this to the global stage one last time. Soros' analysis of the European exchange rate mechanism, the ERM, falling apart after German reunification.
That was a true, far from equilibrium moment. Reunification created these huge inflationary pressures inside Germany.
But the ERM had fixed exchange rates, so every other country was basically shackled to German monetary policy.
And that's where the fundamental flaw was exposed. The German central bank, the Bundesbank, had two jobs that were in direct conflict.
Okay, what were they?
Job one, be the guardian of sound German money, which meant fighting German inflation at all costs. Job two, be the anchor of the entire European system.
And when those two conflicted?
Domestic needs won,
Yeah.
every single time. So when Germany needed high interest rates to fight its inflation, it refused to lower them to help, say, the French or the Italians.
And that refusal was the trigger.
It made the flaw undeniable. It told speculators the system was broken, the peg wouldn't hold, and that led directly to the crisis and the disintegration of a whole mechanism.
So if we pull all these examples together, stocks, currencies, credit, global systems, what's the final takeaway from Soros?
His bottom line is that unregulated financial markets are not self-correcting. They don't tend toward balance. They tend to become progressively more unstable over time.
Because that problem of imperfect understanding is permanent. We can never have perfect knowledge. So what's the goal for regulators?
The goal can't be to create some perfect, optimal system. That's a fantasy. The goal should be much more modest. Just prevent excessive instability.
So stop treating regulation and free markets as, like, a binary choice.
Exactly. There are limits on the spectrum, and we have to find a dynamic balance between them, always remembering that the system is inherently biased.
Which brings us full circle. The belief in perfect markets actually makes them less stable because it fosters the complacency that lets the next bubble inflate. So understanding reflexivity is an edge. You can see when bias is driving everything.
You can, but the final philosophical point is even deeper, I think. Soros says that our human striving for permanence, for perfection, it's a deception.
That's a heavy thought for a finance book.
It is. He says we have to accept that everything we build, every market, every government, is temporary and flawed. We want perfection, but he says life is temporary. Only death is permanent.
So don't try to build the perfect timeless system.
No, focus on making the most of the temporary, imperfect structures we can actually create. Because the great irony is that the better a system seems to be working, the more successful it is, the more it lulls us into the complacency that guarantees the next crisis.
And that leaves us with a provocative question for you, the listener, to think about. Based on everything we've discussed, what structure, market, or technological system in the world today appears so well-functioning, so stable, and so widely accepted, that its very success is already creating the dangerous complacency that will set up the next great reflexive collapse?